We're pleased to welcome now Dr. Ken Cyree, the Dean of the School of Business Administration. Dr. Cyree, good to see you, sir.
Good to see you, Gerard. Thank you for having me.
Looks like you got a fantastic attendance at this year's symposium.
Amazing. We're over 300. We're around 340 attendees, which is by far a record. So it's really been a great morning and afternoon, I'm sure, for us. So it's just excellent to see so many people come out to hear what we have to say and to learn about banking and learn a little bit more about what's going on. So it's fabulous.
I know you've got an impressive lineup of speakers, and of course all the attendees always have a lot of interest in hearing what these experts have to say. But would you agree, Dean, that probably the biggest takeaway, the biggest value is just interacting and networking with the other attendees? They learn so much from each other.
I think so. We've got a broad swath. Last year, I know we had 17 states represented, so you've got people coming in from all over. I imagine will be more than that this year. So it really is a great one-day event, and I think that's important, too, because people don't have to go somewhere and spend 3 or 4 or 5 days in wherever. They can come in and get some information. They can interact. They can learn what other people are looking at, whatever the topic might be that maybe is not even on the program, something like check fraud or something like that. The bankers are looking into those types of things and talking to their colleagues. So I think that's a very, very good thing, too.
What are you hearing, if any, from the field that bankers are interested in this year? What are some of the hot topics?
Certainly regulation. That's always top of mind for bankers. Check fraud, again, that's something that they're very worried about. That's been kind of an epidemic, I think, if you talk to most bankers. And they're also worried about things like cybersecurity. You get someone hacking the bank. Bankers are very good. Banks are much better than certain institutions about protecting themselves from cyber attacks. They have to be, right? Because I think it was Jesse James that said they rob banks because that's where the money is, right? So the cyber people, they don't really care about cracking into the hardware store. They're more concerned about hacking into the bank. So bankers, I just talked to one yesterday, actually, a very small bank, and they said that they had over 250,000 attacks on the bank from outside.
Incredible.
That blew my mind. I honestly didn't know that. I thought maybe 24 would be a lot, but apparently this is nonstop.
It's constant.
Yeah, it really is, which is troubling. And so that's always top of mind for them, too, is how to protect the safety and soundness of the bank, how to make good decisions, how to think about making loans and managing the credit risk. That's always something they think about. And then for the last few years, it's been interest rate risk and liquidity risk, which is something that really bankers haven't had to worry about a lot until inflation in the past few years. And then liquidity risk, actually, which is kind of down in the weeds here, but that was the Silicon Valley Bank deal where you saw basically a run on the bank, which is unusual. But it really was an electronic run on the bank, and that caused the failure of that bank, amongst other reasons. They didn't do very well in managing it, but it certainly was a case study in what not to do. And they did all the wrong things, and bankers are good at learning from others' mistakes. I think they're very good at realizing when they can discover something that other people have done that have caused them problems, and then they adjust, and that makes it better for the economy, makes it better for the borrowers, makes it better for the locals that are doing things, whether it's mortgage borrowing or lending or whatever the case may be. So there's a lot to learn here, a lot to talk about, and I think that's why this is such a great event. You've got a concentration, almost everybody in Mississippi that is associated with banking has some presence here, whether, many CEOs are here, a lot of lenders, a lot of banking professionals, and students and alumni and friends and all sorts of stuff. So it's really, really been a good day.
We've just had a change politically in this country, and that really does dictate and determine a lot of the regulatory environment that we'll be facing. And one of the things that could change in the banking industry is just the capital requirements, which are fairly high. They got a lot of money, sit on a lot of money. They need to sell it. They need to get it out there.
Yeah, that's certainly a part of it. Bankers are always, there's a tension between bankers and regulators. Banks don't want to have a lot of capital because it reduces their return, right? If you have a lot of capital, then you have less leverage and you can't make as much money. And banks don't make a lot of money. The average return on assets for a bank is typically around 1%. So they need leverage to make an acceptable return on equity. I know this is a little bit down the weeds here, but you're a guy I can get down the weeds with here, Gerard. But this is something that that I think will change. And I do think the big thing, which I'm very happy about, is now the lack of uncertainty that we would have had. I honestly thought we might drag the election out for who knows how long, a week or two or three, which is not good for the economy, not good for businesses, no matter who won. And it's good to get this at least moving in the direction where we know what's happened. And I think most business people will be very glad that that's the case.
Yeah, totally agree. I mean, so the bottom line with the capital requirements is it just means that banks have to keep more reserves on their balance sheet. It's less money that's available for them to loan or invest is the bottom line.
That's right.
So it makes it less competitive for consumers and businesses that are looking for capital for loans.
Yeah, it's a governor on growth, too.
Yeah.
You know, it really is. So if you have to hold more in capital, you can't loan that out. So it's a governor on growth. And sometimes that's fine, right? If you've got an overheated economy, you might want to put a little governor on growth. But capital requirements are a little bit more long suffering, I guess, in the industry. So you don't necessarily want to jiggle capital requirements for that. What you want is the ability to protect the industry so that if there are troubles, and there will be, there always are, right? You always have something happen, whatever that might be, that you want to see that banks are protected and doing the right things. And I do think that probably the pendulum has swung a bit too far one way, and I think you'll see some relaxation and regulation, or I certainly hope so. And, you know, I'm sure bankers would agree with that. I'm not so sure about regulators. We'd probably have different opinions depending on who you're talking to. But I do think, you know, it is interesting to me. I talk to a lot of different people. Bankers are generally trying to make good loans to people who can pay them back to help them change their lives. You know, it's they want to buy a house, or maybe the borrower wants to, you know, send their kids to college or start a business or buy a car. Bankers want to make that happen, but they also want to be paid back. And it's interesting that people get upset that they might not get a loan. And, well, bankers want to loan you money, but what they're telling you when they don't make that loan is, look, you've got too much debt. And if you take on more debt, it's going to be difficult for you to pay this back. So that's something I think that the general public doesn't get that message sometimes, and they get upset because they get denied for a loan. But if you know, I'm old enough to remember when bankers would have a 30% debt ratio, and now people loan money even all the way up to 55 or 60% debt ratio. So you've got all this payment going out in debt, and that doesn't include things like the power bill and groceries and stuff like that. That's hard-coded debt every month that you're paying, whether it's car, house, whatever. If you've got 60% of your income, and that's off the top, not including taxes either. If you've got 60% of your income going out for, say, car loans and stuff like that and house, you're broke. You're in trouble. I don't care how much you make. You got an issue.
And we don't want banks loaning money to folks that are in that situation, because it hurts the rest of them when they end up having to write these loans off because of default. So it's a fine line there. They want to sell you money. That's how they make money, but they got to make sure they're going to get paid back. That's the bottom line.
That's exactly right. And it's an inexact science, but bankers do really, really well during normal times like right now. The charge-off rate, which is writing off the bad loans, are almost always below 1%. They're usually around 0.5%. So banks are very good at credit. You know, some people would argue, you know, banks only loan money to people who don't need it. And there's some truth to that, but at the same time, they want to get paid back. Makes sense, right? If you're an investor, don't you want to get paid back? I think so.
So, well, I think we'll have a different environment, a regulatory environment. We could have a different monetary policy environment. Yesterday we got, as expected, a 25 basis point cut. That's on the heels of a 50 basis point cut in September. And Powell seemed to be, I guess, fairly dovish, I guess, about the interest rate environment going into the future. But they're going to keep looking at the data.
I think so, and I think that's wise. You know, I would argue that. Well, let's start with this. I want to see, and I think it's important to have an independent Fed. And, I was talking with somebody in the last few days, and they said, well, Trump, or for that matter, Harris, would want to have influence on the Fed. And I say, well, yeah, every president in the history of the United States would want to have that influence.
Yes.
It's normal. I want to have a good economy, especially around the election, right, because you're more likely to get reelected. So that's normal. What you have to have is the independence of the people on that board, so they can say thank you for your advice, Mr. President, and we're going to do what we think is best for the economy. I think that's perfectly fine.
Yep.
And Powell, I think, he's done a mixed job. He's done some very good things, I think, and he's done some things that maybe he probably wishes he could redo.
Agree.
And, maybe everybody'd say the same thing about us, Gerard. I don't know.
Absolutely.
But, it's easy to be a Monday morning quarterback, but
Hard job.
It is a hard job, and you're working with predictions, which is very, very difficult.
Dean, appreciate you coming on. Congratulations on another great symposium. We're coming right back, folks, from the University of Mississippi Banking Symposium. Stay with us.